Hello, class. Today we're going to study solvency analysis. Through today's study, let the class know what is solvency. What are the classifications of solvency? We are able to follow the financial statements on long-term solvency and short-term solvency indicators to do computational analysis. Now let's look at solvency. What does solvency mean? That's when companies pay off what they owe. Such a capability. And our solvency analysis. It is the ability of enterprises to repay maturing debts. Analysis and evaluation. The solvency of the enterprise. Make scientific and reasonable evaluation. That is to say, this is related to our enterprise financial risk. And even whether the operational risk can be effectively controlled. And maintain a stake in the enterprise. Investor-creditor. There are also some economic interests of our society and the public, and an indicator of our solvency. It can be divided into short-term and long-term solvency indicators. Now let's look at short-term solvency analysis. What is the concept of it? It refers to the current assets of enterprises to current liabilities, and the degree of guarantee of full repayment. It measures the current financial capability of an enterprise. In particular, it is an important indicator of liquidity. What are the indicators measured by? Current ratio, quick ratio and cash ratio. To measure. What does current ratio mean? It is the ratio of current assets to current liabilities. It shows the current liabilities of the company for every dollar. How much liquid assets there are. As such a guarantee of repayment. Reflect the enterprise, a current asset used for cash that can be realized in a short period of time. The ability to repay current liabilities as they mature. What is the formula for the current ratio? It's equal to our current assets over our current liabilities. That's how we calculate it. When using current ratios for analysis, what should we pay attention to? Limitation, first of all. There's no way to evaluate a future flow of money. It's not okay. The second cannot reflect a situation in which the funds of an enterprise are accommodated. What else? Deviation of accounts receivable. Uncertainty in determining the value of inventories, and the effect of our sugarcoating. These are one of the limitations of the current ratio. Now let's look at the quick ratio. The quick ratio is the quick asset of the enterprise. Ratio to current liabilities. This indicator. It is mainly used to measure the current assets of enterprises. You can cash in immediately. Such an ability to repay current liabilities. The formula for calculating it, it's the ratio of quick assets to liquid liabilities. This is our formula. Let's find out. The third measure. Cash ratio. Cash ratio, it refers to cash assets, including monetary funds and trading financial assets and so on. Ratio of cash assets to current liabilities. Let's call it the cash ratio. The formula for calculating it, it's our monetary funds, plus trading financial assets, and then divide by current liabilities. Long-term solvency analysis. First we need to know, what is long-term solvency? It refers to the ability of a business to pay off its long-term debt. What is it measured by? It's the current debt ratio, equity ratio and equity multiplier. Through this, let's measure it. Now let's look at the first metric. Asset-liability ratio. We call it the debt ratio. It's the total amount of corporate debt. Such a ratio to total assets. It is mainly indicated in the total assets. How much of it is financed by our borrowing? And corporate assets. The degree of protection of creditors' rights and interests. This is a measure. Our creditors, an indicator of how secure the money is. What about our debt to asset ratio? What is one of the formulas for calculating it? It's equal to the total of our liabilities over the total value of our assets times 100%. Second measure, equity ratio. The equity ratio is also known as the debt-equity ratio. It is the ratio of total liabilities to total owner's equity. It reflects the funding provided by creditors, the proportion of funds provided by shareholders. It also indicates the funds provided by creditors, the degree of protection of shareholders' rights. The formula for calculating it, it's equal to total liabilities over equity. Multiply that by 100% of our value. Let's look at the third measure, the equity multiplier. The equity multiplier is calculated for every $1 invested by a shareholder, the amount that can be physically owned and controlled when our business is in debt. The equity multiplier is greater than 1. The higher our corporate debt, the greater the equity multiplier, equity ratio and our equity multiplier. There are two other forms of asset-liability ratio. The most commonly used indicator of the level of financial leverage. Equity multiplier. It's the ratio of total assets to shareholders' equity. So the formula is total assets over shareholders' equity. Through the study of this chapter, let the students know the business management process. We often touch on the relevant financial knowledge. By learning, students need to understand the content of financial management, learn how to forecast capital needs, master our accounts receivable management model, learn to analyze solvency. This financial knowledge, it is our small and medium-sized enterprises, some basic knowledge of business and management process, the one that can't settle, must be a confused enterprise. Think about it for a moment. In our SME organizational structure, what is the position of the finance department? How much impact this sector has on the business? Thanks for watching. Goodbye.